Jordan Roy-Byrne from thedailygold.com is back once again today to talk cup and handle. This and more on this week's episode of Metal Money. I'm your host, Patrick Vieira. Jordan Roy-Byrne, welcome back to Metal Money. How are you doing?
Hey, Patrick. I'm well. Thanks so much for having me back. How are you?
I'm doing well. Glad to have you back, Jordan. Appreciate the time. Last time we spoke, you had said that we need to see one of two things happen for gold to get to that $1,900 level and on to new record highs. Either we need to see inflation accelerate or we're going to need to see a stock market correction. We are seeing that inflation accelerate. So does this sentiment still hold true for you?
Yes. I think the other thing that I'm looking for is also a rate hike, because I don't know if you and I have spoken about that, but if we look at gold's history, there's 8 times in the last 60 years or so when the Fed shifts policy to start hiking rates. And it's very interesting because conventional wisdom would say, oh, well, that's not good for gold. But actually what happens is if you look historically, every major bottom, or most of them, you could say, the historical major bottoms in gold coincide with the Fed starting these rate hike cycles. And that's because usually the Fed starts hiking rate. They start a new rate hike cycle because inflation is starting to accelerate. And we know that the only time in history that the Fed stayed ahead of the curve and actually hiked to combat inflation was 79 to 81, I think. So that's the only, so every other time the Fed basically, they started hiking, it was an admission that inflation was picking up and they needed to start hiking. So that explains why the Fed hiking rates historically can actually be very good for gold. And if we look, typically, not in every case, but in many of the cases, gold tends to decline, not significantly, but maybe it declines 4 to 6 or 7 months before that rate hike comes in. But then it has a really good rally. Like I think the last 4 times the Fed started hiking rates, from that point, the average gold rebound was, I think, about 27 or 28%. So that's also another catalyst. And that ties in with inflation accelerating, because if inflation, if the expectations, and that's been happening in the last couple months, the market previously thought that inflation is transitory. It's going to come down next year significantly. But if you look at the last month or two, the market is starting to anticipate higher than expected inflation for next year. So that definitely, if that continues, the Fed is going to hike rates sooner rather than later. If you look at the Fed funds futures, it's looking like it could be around June, July. Maybe if inflation continues to stay really hot, they could hike as early as May. So that's also a catalyst for gold. But, and I also think next year we could get a stock market correction. I don't know if, maybe that could happen in the next couple months. Maybe it'll be 6 or 9 months. I don't know when. But with all these things being said, Patrick, I am very optimistic for gold next year. I was not coming into this year, but I think the way these things are lining up, a rate hike, likely the stock market is going to run into some problems, inflation, the expectations for next year are picking up. And at the same time, the growth expectations are slowing. And that's also an important factor, because one reason why gold has corrected, if you look at, I saw a great chart on Twitter. I can't recall who it was from, but it showed the GDP expectations and for GDP growth in the U.S. And this was rising during most of the period when gold has corrected. Until the last month or two, it's actually started to trend down. So the combination of expectations for slower growth next year, but inflation picking up a little bit, that's stagflationary. That's good for gold. So that could be, that's why gold is starting to see more buying. I think the growth component, the market is now concerned that growth is going to slip next year. So I know it's a really long answer, but there's a lot of potential catalysts for gold coming up next year.
That's a great point. Jordan, we've discussed before gold's mega cup and handle pattern on Metal Money. Now, outside of gold, you'd mentioned that the best example of a historical cup and handle pattern is the stock market as the U.S. exited from the Great Depression. Can you share with us why it is the best example of the pattern and how it hit its projected targets?
Well, it's very interesting because the cup and handle pattern, you see this on shorter time periods. So if someone is looking at a daily chart, or if they're looking at even an hourly chart, you can see lots of cup and handles over, a 1 month period or a 3 month period. But the pattern itself is really bullish. But gold, I mean, now it's 10 years long. And it's interesting because historically, there's not that many of these patterns in the major markets. But the pattern is bullish in the fact that it's occurred for gold over 10 years. That's when you get a breakout out of that pattern. I mean, that's going to be a launching floor for gold over not just the next couple of years. I mean, gold should do, it could do really well for 5, 7, maybe even 10 years coming out of that pattern. And so there's just not that many. Why is the stock market, why is that the best example? Well, because it's one of only a couple examples, really. But if we look at that, our viewers can they can pull up the S&P or the Dow from, let's just say 1932 or 1930 to 1960, and the cup and handle in the Dow actually the cup went from 36 to 46, and then the handle I think was about 3 years, maybe a little more. So it did take the whole pattern and the breakout took about 13 years, but you have these simple measured upside target, and that's just you measure the rim of the cup from the bottom, and so you add that to the rim, and that's how you get the target. And so gold hit that I think in 1954. So about or not gold, the stock market, the Dow. So 4 years after the breakout, that's when it hit that pattern. However, you can also use what's called a logarithmic target, which is you're measuring the percentage from the top of the cup to the bottom, and then you're applying that percentage. So, for example, let's say you had 100 to 200. The simple target would be 300, but the log target would be 400, because if it's went from 100 at the bottom to 200 at the rim, that's a double, so you double from the breakout point. And so I've been talking about for gold, the measured upside target is about 3,000. However, I haven't been talking about the log target, using the percentage method, which is viable. And depending on how you measure it, that comes in I think at like 3,700 or 4,100. I mean, if you want to be aggressive, you could say 4,100. If you want to be conservative, you could say 3,700. But so, looking at what, the Dow did from 36 to, 1950, 51, when it had that breakout, not only was the stock market, it was able to hit both those targets several years later, 1956, but it continued to rise after that point. So, I mean, that was a 13-year cup and handle pattern. When you break out of that kind of a base, that tells you the market is going to be trending higher over the very, very long term. And another example of that was Hong Kong had a cup and handle. It had a huge cup and handle pattern from 1973 to about 1985. And it's interesting because the handle on that cup and handle pattern is actually its own cup and handle pattern. And we're seeing something similar with silver, actually. So silver looks similar to the way Hong Kong did decades ago. But, Hong Kong had a huge breakout in 1986, into that stock market crash. But even after that crash, from the late 80s until I think 93, 94, I'm just looking at it, the Hang Seng went from like 2,000 to 10,000 after the stock market crashed. So there's not, and then gold has some of its own historical examples of cup and handles, but they're kind of unconventional. But just this historical look tells you how powerful the pattern is, because it gives rise to a bull that continues for years and years, and it goes beyond the simple target and the log target. And so for gold, uh, again, I mean, we have a 10-year base. If gold breaks out next year, that's an 11-year base. That's not the kind of base where gold's just going to go to 3,000 and then it's going to fall on its face. I mean, that's setting gold up for the huge breakout move. I think it's going to get to 4,000 in 2 or 3 years after it breaks out. And, at that point, maybe we get some kind of bear market where gold comes back for a year or two, but then after that, gold goes up again, and it goes to 5, 7, 8,000, whatever, as we get to the end of the decade. I mean, it could look something like that, but it's just the cup and handle pattern. Naturally, it's really bullish, and so when you see that pattern on you have a base that's 10, 11 years, that's really significant. That implies you're going to see very strong performance, not just for 2, 3 years, but 5, 7, 8, probably 10 years.
You have a chart in your gold's super bullish cup and handle pattern article that shows the gold price since the 70s with the numbers 1 through 4 marked on it. Can you walk us through the significance of this chart?
Well, these are the historical examples of cup and handles for gold. And there's three of them. We're now on the fourth. And the other three are kind of unconventional. Now, the first one was from 1974, 75 to about 78. And that's when gold had that 45% decline and it rocketed back up. But gold was so strong when it came back that the handle on that pattern, you could barely see it. And it was only 4 months. So that was unconventional. But obviously, when gold broke out and it got back to the original high, it broke out, made a huge move. Then it had a 20% correction to retest. Then it just went vertical after that. If you look at number 2 and number 3, these are really interesting because number 3 is from 1996 to 2004, and if there are some similarities between that cup and handle and today. However, it's unconventional because a cup and handle, it's what's known as a bullish continuation pattern. So 96 to 2004, that was a cup and handle out of a bottom, which is unconventional. It usually doesn't happen like that. The pattern is more like what gold has done recently in this cup and handle. That's more conventional, so it's more significant. But if you look at that number 3 in 96 to 2004, gold had a very bullish correction from 2004 to 2005. I think it only lasted 16 or 17 months, and then gold went vertical. And if you look at number 2, I mean, that's also an unconventional, kind of a rough one. I think that's about 98 or 99 to 2002, 2003. So that that wasn't that significant because it was only over a few years, and so the measured and the log targets were not that hard to achieve. But if you look at those three, what's interesting is they all hit the measured, the simple target, and then the log target soon after that. So I mean, it's only 3 examples. I mean, does that mean that, the cup and handle that we're in is going to hit the log target like really soon? I mean, it's possible. I mean, the cup and handle now is the most out of those, out of those 4, the cup and handle now is the most pure. It's, the most textbook, and gold has only, we've probably seen the bottom in this correction as we build this handle. In gold, it only retraced 38% of the previous move up from 1050 to 2070 or whatever it was. So that also is a sign of strength. Like, even if gold came down to 1550, there still would have been a viable handle. But the fact that it only retraced 38%, that's a sign of strength. And on top of that, the rim on the right side of the cup, the rim is higher than the left side. So that's also, and you see that sometimes, that's also an example of a little more strength. So those factors are showing that this is a very, very strong bullish pattern.
Looking at the current gold cup and handle pattern, what are the current arithmetic or arithmetic, depending on people, and logarithmic targets for gold, and how far out are they?
Good question on the timing. So the arithmetic or arithmetic, I think you can pronounce the word either way. But yeah, I think in this sense, arithmetic, that's just the simple one. So that's where I get the 3,000. I think I take the 2070 minus 1050, and that gets us to, I think, 207. I think that gets us close to 3,000, maybe not quite there. But that's one way to look at it. And the logarithmic, that's the percentage that we were talking about before. Where if if we take the 2070 and the 1050, that's about a doubling. So a doubling over 2070 would get us to roughly 4,100. But the timing, I'm going to do more work on that. It's difficult to know. It's difficult to know because there's not a ton of history on gold, believe it or not, because it's only been through a few different cycles. But my guess is, I'm looking at, when I look at gold's history and the rate of change over a 2 or 2.5 year period, there have been several times where gold has doubled in that period. So, and again, that's over a 2 and a 2.5 year period. So let's say gold breaks out 2022. Let's just say it's the middle of 22. So that would put us 2024, maybe towards the end of 2024. That'd be almost 2.5 years. And so a doubling from, depending on which low we're picking from, that would probably get us close to, 3,500, somewhere in there. So that's, maybe we could round that up, because that for hitting the log target, 4,000 by the end of 24. So about 3 years from now, that's a viable target. Now, that doesn't mean that like you should go out and immediately buy risky options and all of that, because we're just guessing. But the key takeaway is, when gold does break above, we can say 2,100 to make it easy. We're rounding up. When gold does that, that's going to tell you that, gold has begun what could be a really accelerated move over the next, 18 to 24 months.
You've mentioned before that the cup and handle pattern in silver is less perfect than in gold. How does this impact your outlook for silver in the context of this pattern?
Well, it impacts my outlook because for silver, in that silver is farther away from a breakout than gold. Silver gold, we said it only retraced 38%. I think silver retraced 75%, maybe 77%. Whatever it was, something like that. So cup and handles are really only supposed to retrace 38% or 50%. But if we look at the Hong Kong example during the 70s, that I think it corrected like 90%, and then it rallied all the way back and made this huge cup. So simply put, with silver, it is a cup and handle pattern, but it's less textbook than gold. And so the fact that there's been this bigger correction and silver is still far away. I mean, silver has to double just to get back to the high. So I see gold breaking out of the pattern sometime next year, and it's going to happen before silver. So silver will eventually, but if we're looking at when that could happen, if we're looking at the gold silver ratio, maybe gold is going to be at 25 or 2,700 before silver gets back to 50, unless inflation expectations are really going crazy. So that's the nuance to this view, is silver outperforms gold when inflation expectations are really accelerating. However, next year, what if we have a stagflationary issue where inflation is still staying at these levels, but growth expectations keep coming down? That's going to help gold. Gold can perform in that environment. Gold would really outperform everything. So gold could still break out, but silver would lag gold. And so that's important to keep in mind. And so maybe it will be silver won't break 50 for, 18 months or 2 or 3 years. It'll probably happen when inflation is really raging again. So I don't see silver breaking 50 next year. I think it's possible it could underperform gold. But, that being said, if gold's going to break out next year, maybe when gold breaks out and it starts trading about 2,100, that's probably the time you silver, if it's underperforming, that's the time when it can start to catch up and maybe start outperforming gold. So there's a lot of nuance in there. I hope that wasn't too tricky.
It's always tricky, but Jordan Roy-Byrne from thedailygold.com, we appreciate the time you've given and the analysis that you've given, and I hope we can do it again soon.
My pleasure. Anytime. Thank you for having me, Patrick.
That was Jordan Roy-Byrne from thedailygold.com, helping us to get a handle on the golden handle. As always, please leave your thoughts in the comment section below, and remember to keep it liquid, keep it real. And I'll see you on the next episode of Metal Money.